Hi there, it's Jeff here. In this video we're going to take a look at the key concept of import substitution. The backstory is, of course, the decision in early April 2025 by the Trump administration to effectively increase tariffs to their highest levels since, well, before the 1930s. The forecast from April the 3rd is for the full year of 2025 is an effective tax rate on imports and coming into the States of 22%, weighted, of course, by the amount of trade. That is a remarkable increase, big shift towards protectionism. Here's the data showing US tariffs on the largest trading partners in April 2025 by share of imports. So, for example, the European Union has 18.5% of US imports. It's been levied with a tariff of 20%. China, 13%, levied with a tariff of 34%, an extra tariff of 34%, so on and so forth. Now, this is part of a strategy of import substitution. So these are the countries that have been levied with a 10% tariff, and these are the countries where the tariff is double that or more. So what is meant by import substitution? You're going to hear a lot more about this concept in the weeks and months ahead. Well, import substitution is a strategy aimed at reducing a country's reliance on imported goods by getting consumers to switch or substitute away from imports towards domestically supplied or domestically manufactured products. The idea is to replace overseas made products with those made at home. It's often, in past, it's been used as a development strategy, as an interventionist approach by emerging and developing nations trying to build up to scale their own industrial base. But as we're seeing with the United States this week, it's also being used for strategic, fiscal and geopolitical reasons. So tariffs, as you know, are taxes. Let's repeat that. Tariffs are taxes imposed on imported goods. And the idea is that by making imports more expensive in relative terms, tariffs cause an expenditure switching effect, shifting demand towards domestically produced alternatives, and in theory causing an increase in output and investment in domestic sectors, be it car manufacturing, pharmaceuticals, textiles, sport and leisure wear, and others. As a quick reminder, here's the tariff diagram. So this could be the demand, domestic demand and supply of cars in the United States. If the tariff increases the world supply price, assuming other countries can produce cars more cheaply, so the price goes up, domestic demand contracts from Q2 to Q4, but the key thing is that domestic supply, in theory, expands from Q3 to Q5. That is the import substitution taking place. Demand as a whole goes down because imports are more expensive, real incomes have gone down, but there's a shift in consumer spending towards domestically produced goods. Import substitution, the volume of imports therefore decreases to Q5 to Q4. So there's your diagram if you want to talk about import substitution effects from a tariff. There are, of course, limits to this strategy. First of all, domestic goods are often, they cost more than imports. Cambodia and Vietnam and Indonesia and Turkey and other countries can produce sport and leisure wear at a relatively cheaper price than the United States because they have a comparative cost advantage compared to the USA. So domestic goods often cost more. Tariffs lead to higher prices. Let's be clear about that. Tariffs cause inflation and consumers bear the brunt. They face welfare losses. Their real disposable incomes effectively goes down. And also businesses rely on imported inputs. So you might be a farmer relying on imported fertilizer or potash, which is used to make fertilizer. You might be a car manufacturer using imported steel. Well, unless the domestic sector can produce that steel at the same price, your costs will go up as well. Secondly, the danger of retaliation and trade wars. So if you target one or more countries, in this case, nearly every country in the world, targeted countries may retaliate with their own import tariffs, and that, of course, damages export businesses. And you can very quickly fall into a damaging tit-for-tat trade war. And then there's a debate amongst economists, but most economists argue that import substitution, whilst potentially effective in the short term, has limited long-term effectiveness. If you put up a protectionist shield, you might be protecting domestic industries in the short run, but if there's no competition, if the markets become less contestable, they then may lack the incentive to innovate, causing a decline in both productive and dynamic efficiency. You get X inefficiencies emerging. And think about the impact on global supply chains, which have been built over the last 50, 60, 70 years. Many industries are integrated deeply into global supply chains, so disrupting those with tariffs on this kind of scale and scope can reduce efficiency and productivity. So tariffs are designed to lead to import substitution. We will wait and see how this all pans out in the weeks and months to come. My instinct is that the import substitution effects will be limited because there's no guarantee that the US economy has the supply side capability and capacity necessarily quickly and easily to switch towards the goods that have now been subject to a tariff. Thanks for joining in. Stay safe, stay curious. See you sometime soon.